Hi, everyone. Welcome to section 13.5. In this section, we'll talk about financial investments. So what are the objectives of this lesson? We're going to explore and analyze stock investments, bond investments, mutual fund investments, returns, and building a nest egg. And what do they mean? So we wish to identify a little bit more on investments, all types of investments, stock, bond, mutual, returns, and nest egg. Let's first talk about what a definition of a stock is. So most of you should be familiar with the term stocks, or buying a stock in a corporation makes you part owner of a corporation. When you buy a share in profits of the company makes, then you share the profits. It's called the dividend. So when the company makes any profit and it's shared to you, it's called a dividend. The profit you make by selling for more than you paid is called capital gain. So let's say that you bought a stock and it's now selling for more than what you got. That's called capital gain. A negative gain is a capital loss. So instead of getting more money, you actually owe. That's if you're selling it less than what you paid. So you can have capital gain and you can have capital loss. Now, by return on investment, we mean the net difference between what you receive, including any dividends, and what you paid. So pretty much is the return on the investment, how much you're paying versus how much you're getting. The price of a share of stock is determined by the law of supply and demand at all institutions called stock exchanges. So the stock exchanges is what determines the price of each stock. Okay, so there's shares of stocks. So how many shares you can buy on a specific company. Let's look at an example. You buy 100 shares of stock in company X on February 2nd, 2022. This is how much you pay per share. So if it's how much is gonna cost? Well, you have 100 times 28.50. You receive a dividend of 60 cents per share on the stock price, and it has risen to 29.75. Find the following. First, we want to find the total cost of the stock. So the total cost would be 100 times your 28.50. The total dividend is, there it is, there's your dividend, there's your 0.60, and it has risen to 29.75. You're going to look at the gain of the stock and the total return and percentages returned for 1 year of ownership. So we need to look at the dividend. We need to look at the price, see how it increased in price. And you're getting per share 0.60 cents. So let's review this question together. There it is. The total cost will be 100 times the cost of the share. You bought it for $2,850. Your dividend is your 100 share times the 60 cents of the dividend. That's $60. Now the capital gain is how much you got it for. So how much the $29.75 is the price. That's now the new price, $29.75 times 100. That's the $29.75 minus how much you got it for. You got it for $28.50. So now your total gain is $125. The total return is what you got from profits. Well, you got $125 plus the dividend. So this is going to be the capital gain plus your total dividend. Now, the last part is they're asking for what is the percentage return? So with the percentage return would be the total return. Let's write that formula. The total return over the original price cost, the original cost, times 100. Why 100? Because I'm looking for a percent. That gives me 6.5%. That is the percentage of return. Okay. So actually you're getting money from this share because the price increased. So you got a capital gain of $125. You have a total return. And you have to look at the percentage return. Now, how do I read a stock table? So usually year to date percentage of change. If it's a positive number, it's a 3.5% increase so far in this year. Now, the highest paid and the lowest paid in the last 52 weeks. The highest was 19.55, the lowest was 12.66. Now, the stock, Warden's word, this is the company. This is how much you're being paid. So there's your dividend, the div, annual dividend, the percentage. So 0.53, this is the cents, the amount, this is a percentage. And the 35 is the price to earning ratio. So the stock price is divided by the earnings per share over the last 12 months. PE, price to earning ratio. So PE is the price to earning ratio. That's the 35. There's the dividend, percentage, price to earning ratio. So whenever you have a stock that looks like this and you're reading a stock table, then you should identify the different types, the percentage of year change, the stock increased by a 3.5%. The highest price of the stock within the last 52 weeks, the lowest, the name of the stock, the annual dividend, the percentage, and the price to earning ratio. Okay. So similarly, there is another type of stock table where you have vols, the close, and the net change. So the volume 100s is you're multiplying how many shares were sold. The volumes of shares is 1,411 times 100. So that means 141,100 shares were sold. This is how many per. So this number times this number, how many shares were sold. The close, the stock price close of the day, this is how much it closed. And then this is the net change. This is it increased on the previous day. It's worth higher than one day before. So for example, let's say that today, let's say Apple, the share of Apple is $100. I'm not saying it's $100, it's assuming. And then tomorrow, the stock, it's going to be 105. So there is a net change of $5. So there should be a closing cost per day. So this is the closing cost, the closed of price of the day. So that will change. And that's going to be the difference of amount from previous day. From the previous day. So there could be different types of stock tables where you need to learn how to read the tables. We also have brokers. Well, brokers fall into two categories. There exists the full service brokers who offer research recommendations for stock to buy and sell and offer other services, including wealth management, retirement planning, and tax advice. So brokers, they have different services, including tax advices, retirement, wealth, anything that deals with like financial planning. They also have discount brokers. They execute purchases and sales of stocks for their clients and may offer educational information to help clients make sound decisions, but do not make specific recommendations to any client. So they help them with the sales and the purchases of the stock, but they don't educate them. They don't do specific recommendations. They're not suggesting them, whereas full service brokers do. So discount brokers do less. So they can educate you in some portion, but they do not make any specific stock recommendations, whereas a full service, they do. They kind of tell you where to invest, what are good recommendations, whereas discount brokers, they are only executing purchases and sales of stock for their clients. Let's talk about commissions. Well, commissions, brokerage firms charge commissions. So for example, if I'm a broker and and I'm in charge of your stocks, I'm going to make commission. There's a broker fee for executing an order. So for example, you tell me, oh, I'm looking at the stock market right now, and I think you should sell your stock because you're going to get profit from there. Because I'm going to make you make money, then I deserve a commission. So for a full service broker, commissions are normally between 1% to 2% of the principal of the purchase or sale. So they will get from anywhere between 1% or 2% of the principal amount. So every time I either sell or buy a stock, I should get between 1 or 2 commission from that amount. That is the commission for the brokers. So let's look at the typical discount commission structure. So for example, we have a different types of brokers, firm A, firm B, and firm C. There's discount brokers and there's their full brokers. When it's an automatic, automative, online, there's a 0, but the broker will charge a 32.95 commission. If the broker firm B has an automated that costs $1, then the broker assistant commission would be $19.95. And you have the broker firm C, which is the full broker that does the recommendations, add and sells. They get 1.5% of your commission of the broker assistant. Okay. So this is a typical discount structure. So see how the broker assisted is percentage wise as the discount has a firm quantity amount. Let's look at bonds. What are bonds? So for bonds, you may lend money to a company receiving an agreed upon rate of interest for the use of your money. In this case, you would buy a bond from the company. The bond or loan, so a bond is a type of loan, is issued with a stated term of lifespan, and the bond matures and the principal or the face value is paid back to you. So bonds is a type of lending money where that bond matures or it has an increase in principal amount that is paid back to you. Okay. Let's look at this problem. Finding the return on a bond investment. So again, a bond investment is a type of interest, a loan. So when you have $5,000, so this is the principal amount, invested in a 10-year, this is the time, T equals 10. This is the rate, 0.075. And it's paid semi-annually. So that is twice a year. Find the total return on the investment if it's held to maturity. Well, we have the interest is the simple interest. I is equal to PRT. PRT. So first, we're going to look at the simple interest, which is going to be 3,750, because we're looking for an interest of the bond. We are going to look at the paid semi-annually. So for example, we wouldn't use the one before, so we wouldn't use like N to be 12 and monthly, so 6 months. We would use the simple interest formula. So every time you're looking for a return on a bond investment, you're going to use the simple interest rate formula. Okay. There's also mutual funds. A mutual fund is a pool of money collected by an investment company from individuals and or institutions and invested in many stock, bonds, or market instruments. So a mutual fund is a pool of money collected by an investment company. So there exist mutual funds. Okay, so let's write that definition. Now, mutual funds versus stocks and bonds. What are the advantages of mutual funds? So they're very simple, the simplicity. Someone else does the work for you on a mutual funds. There's diversification. So you own interest in many different stocks, which decreases vulnerability to large losses in one particular loss. So for example, you just don't own one, but there's a lot of mutual funds. You're going into more, you're not just relying on one stock that will lose in value, but there's you have interest in many stocks. You have access to new issues. The large assets or fund managers give them more clout to get initial public offering, IPOs. So initial public offerings stand for IPOs, which can be profitable instead of the stocks and bonds. So mutual funds, somebody else does the work for you. You're just getting interest from those stocks. Okay. There's more benefits. Economies of scale, large stock purchases usually incur smaller expenses per dollar invested. Professional management. So normally people who take care of your bonds, your stocks, are brokers. So professional managers may have the expertise to pick stocks and time purchases to better achieve the stated objectives of the fund. So for example, if I hire a financial planner or somebody who is a researcher and knows about stock exchanges, then I'm going to hire that person and they will do the selling and the stocks and everything for me. There's also called indexing with minimal management. An index fund, this is an example of a fund, an index fund can maintain a portfolio that mimics a popular index such as the SP 500. This makes it easy for the individual fund investors to achieve returns at least close to those of the index. So what the index fund does is you're trying to maintain money or return as much as possible. So remember when we saw the return for that first example, we want that money to increase, right? We want to make sure that we always have money in those particular funds. Again, continuing with the impact of one-time charges and recurring fees. So sales charges, management fees, these are the different types of fees, the sale charges, the management fees, the 12B1 fees, and the fund expenses can mount. So every time you buy a stock, every time you buy a fund or a mutual fund, these fees can sum up, can mount up. There's also hidden cost of brokerages. So for example, if I decide to have a stock or a bond or mutual funds and I want to hire a pool brokerage, then I know for a fact that they're going to stay with a 1% or 2% they're going to have commission. But sometimes there could be hidden costs. So recurring fees and expenses are added to give the exposed ratio of a fund, but commissions paid by the fund or for stock purchases in addition to the expense ratio. So everything will sum up at the end of the day. The person who is in charge of selling my buns or funds or stocks, then they will make a commission in addition to the principal amount for what they paid for. Okay. There's also exists hidden risk of fund ownership. So when you have a fund, in an event, let's say the market crashed and you have plenty of funds there, when you're trying to get out of the cash, there's mean accepting securities rather than cash. And these can be difficult to redeem for a fair price. So for example, let's say you have funds, and instead of giving you the cash, they give you something else. They give you securities, which might not be as redeemable as a cash. Managers may stray from the stated strategies of the fund. So the people who own these funds can also have particular strategies for the fund. There's also tax liability is passed to fund investors and depends on the purchases. So you are also taxed by this. So it depends on the purchases and sales made by fund managers. Investors may be unable to avoid inherent unwanted tax bases. So for example, let's say that you have stocks and you have what was those famous those coins, those coins that the Bitcoin or something like that. There were some coins that were very famous that people were buying and then they got sold for some particular amount. People were taxed for those. So just making sure that you're well aware of the impacts of a stock and the money that you make out. There exists the net asset value of a mutual fund. So let's look at the formula. The NAV, or the net asset value, has a formula of A minus L over N, where A stands for the total fund assets, L is the total fund liabilities, and N is the number of shares outstanding. So we can calculate the net asset value by subtracting the total funds minus the total liabilities over the values of shares. Okay. Let's look at this example. A mutual fund has 520 million worth of stocks, 700,000 in cash, and 300,000 in other assets. We found the fund has also 4 million in liabilities. Let's write down the liabilities. If there are 30 millions of shares outstanding, find NAV. Well, first of all, let's look at A. Well, A is the total amount. So it's the 520 million plus the 700,000 of cash plus, so it's the total. So you're accumulating everything there, there, and there. 300,000. That gives you a total of 521 million total fund assets. These are your assets. Now you want to subtract it by your liability. So your liability is it's 4 million. This is the liability. And this N is the shares, the outstanding shares. So remember, N, the NAV is A minus L over N. So it's 521 million minus 4 million over 30 million. And you can plug this in your calculator, and you're going to get $17.23. That is the total net asset value. Okay. The total net asset value. A minus L over N. So you first had to sum up the 520 million, everything in cash and other assets. So combining all of your assets together, your total assets minus the liabilities over the N value, the number of outstanding shares. Evaluating investment returns. So it is important to be able to accurately evaluate and compare returns like profits and losses, even though past performance is never guaranteed for the future. So you can't really like say, oh, I know for a fact that it's going to be increasing or decreasing. So it's never guaranteed. It's very crucial information. A wealth of information on stock and bond markets and mutual funds is available through publication and internet resources. So if you want to look at, okay, different types of bonds, mutual funds, stocks, which ones are the ones that are more profitable, there's a lot of research for you through the internet and publications. The most important a measure of performance is the annual rate of return. Remember, it's not always the same as a percent of return because it depends on the period of time. So for example, normally, if a stock is kind of decreasing in price at a certain period of time, like right now, the stock market of maybe like Apple or McDonald's or different shares that kind of fluctuate, or some that are constantly increasing. For example, shares from Walmart, things that are very popular that people kind of use very often. Let's look at this example. Let's look for the mutual fund annual rate of return. So you own shares of a mutual fund, and the only return that the fund earns is a dividend of 0.5% per month, which are reinvested. Find the annual rate of return. So you're going to use the dividend. So the return or the relative return is a formula. The return relative is 1 plus 0.005. Well, where did they get the 1.005? The rate is 0.005. You move 2 decimals to the left, and you do 1 plus r raised to the n. 1 plus r raised to the n. This is the formula for the return relative. And this is n compounded monthly. There's 12 months in a year. So you're going to get 1.005 to the 12. Now, which gives you 1.062. Now, to find the annual percent, because that's what we're looking for, you do 1 minus 1.062. We get 0.062. We multiply that value by 100 to get the percent, which is 62%. So we first add it and then we subtract it. So we do 1.005 raised to the 12. When we punch that in our calculator, we're going to get 1.062. Then we have to take 1 minus that value because since we had added, now we have to subtract it. And that gives you the percent. Okay. How do we build a nest egg? So the most important function of investing for most people is to build an account for some future use, probably for retirement living. So for example, if right now I'm 30 years old and I wish to retire and get some money, I want to start investing in something. I don't know, maybe investing in stocks, maybe investing in mutual funds and bonds, something that will give me money for the future. I want to create it and I want to create an account that's going to be prosperous until when I retire. So the future value of inflation adjusted retirement account, assume that the annual deposit into a retirement account adjusted for inflation now there's a formula that we're going to do for a retirement account. I will be the annual rate of inflation. R is the initial deposit by the end of year 1. R is the annual rate. N is the number of years deposited are made. And V is the total amount within any year. So for example, I want to retire. I did a principal investment. N is the number of years deposited, I made, and then I was the rate of inflation. So we're going to have to find adjusting a retirement account for inflation. So we're going to use this formula in this following example. Find the final account value for an account paying 8% with initial deposit. So there's my rate, 8%. I have my initial amount. This is R. R is 2,500. In this case, N is 30 years. N is 30. And for an inflation, so a little I will be 4% or 0.04, and R is 0.08. So we're going to go ahead and plug it in my formula. There's my there's R, my 25,000. There's my formula, 1 plus R, my rate is 0.08, raised to the N, which is 30, minus 1 plus I, my I is 0.04, and then R minus I. I'm going to go ahead and punch this in Wolfram Alpha. So we know that there exists Wolfram Alpha that we can easily substitute, and we can round our answer to a final amount, 426,203. So when you are doing a formula for a retirement account for inflation, you must know R, N, I, and little r. Okay. So after 30 years of deposits, I should, instead of having 2,500, I should end up with $426,206, $203. There's also called the tax deferred versus taxable retirement accounts. So in both of those cases, so there's tax deferred and taxable retirement. There are two different ones. In both cases, R is the amount withheld annually. N is the number of years. R is the annual rate of return. T is the marginal tax. V is the final value of the account, following all accumulations and payment of all taxes. This is in both cases. What do they share? So the tax deferred and the taxable requirement share the following: the account withheld, the number of years, the annual rate, the marginal tax, and the final value. Now, the tax deferred versus the the requirement. Now, look at the following formula. They're different. The tax deferred account, the entire amount R is contributed each year. All the contributions plus earn a return over N years, at which time tax is paid on all money in the account. The final account value is calculated as follows. Look at the formula, 1 minus T, and then R, the rate, the amount R contributed each year, 1 plus the rate, raised to the N, how many years, minus 1 all over the rate. This is the tax deferred. This is the tax deferred formula. Whereas the taxable account has a different formula. So they look the same, 1 minus T, but now look at the R on the outside. They're different. Each amount R is withheld from salary, is taxed up front, decreasing the value of amount deposited to 1 minus TR. Furthermore, annual earnings are also taxed at the period of each year, but at the end, the accumulation period, no more tax will be due. The final account value is as follows. So look at the values. Look at the R here and look at the R here. They're not in the same location. 1 minus TR in the front versus R in the front. When the R is in the front, that is the taxable account. Let's look at this one. Compare the final values of a tax deferred account and a taxable account. So we're going to have to do this for both the taxable deferred. So we're going to use the formulas. We're going to plug the information that we know for the tax deferred and for the taxable account to see which one is better. So there's R, there's the value of R, there's the value of N, there's the value of little r and T. So now Let's look at the first formula because the tax deferred is 1 minus t times r, 1 plus r to the n minus 1 all over r. Let's write this down because we're going to write down the formula here. There it is. 1 minus t r, 1 plus r to the n minus 1 all over r. So when we plug it in, this is the tax deferred. We're going to get 158,116.37. So we're going to compare this value versus the taxable account. Now the taxable is r parentheses 1 plus r times 1 minus t to the n minus 1 all over little r. And we're going to get 128,403.15. So which one is better? We notice that the tax deferred will have 29,713.22 more than at the end of the period. So it looks like the tax deferred will be a better candidate. So to find that result, we had to do 158,116.37 minus 128,403.15. That gave us the 29,713.22. So that means we're making more in the tax deferred than in the taxable account. And with that, we finish section 13.5. Thank you. And these are all financial investments. Thank you, and I will see you on the next recording. Bye.